As mortgage rates reach all-time lows due to the pandemic, demand for real estate has increased significantly, but that does not necessarily mean you should go out and buy a house right now. If you already have real estate investments, now might be a great time to consider refinancing if doing so will put you in a stronger financial position. However, in this video, I want to speak to those of you who are considering buying a house during our current virus pandemic. I also want to present some mortgage advice that is designed to prevent you as a new homeowner from overextending yourself. So if you have been looking for a new home during the pandemic, you are not alone. With record low mortgage interest rates and more people working from home, some people are considering an upgrade or even entering the market as a first-time homeowner. In fact, according to a recent report by the National Association of Realtors, existing home sales have jumped by 20 to 25% over the last couple months. But what's important to remember, guys, there's way more to buying a home than covering your monthly mortgage payment, which also increases as property taxes and homeowners insurance premiums go up. To prevent buyers from the stress of owning a house they cannot afford, experts came up with what they call the 30-33 rule. So this rule has three parts. Ideally, you want to follow all three, but if not, then at least try to follow one of the three. So one way to measure how much home ownership you can afford is by following the 30-33 rule. This rule advises that you shouldn't spend more than 30% of your gross income on your monthly mortgage payment. It also suggests saving 30% of your home's value, 20% for a down payment. Of the 30%, 20% is for a down payment to prevent private mortgage insurance, and 10% as an emergency buffer. And finally, limit your home's value or purchase price to 3 times your annual gross income. All right, Joe, now I'll go more into depth on each one of these rules and the reasons behind it. So, rule number 1, spend no more than 30% of your gross income on a monthly mortgage payment. Now, the mortgage industry already advises that your monthly mortgage should not exceed 30% of your gross income. But as mortgage rates continue to decline, many people may be tempted to go beyond 30%. When rates are lower, you can afford to spend more money on a home. Now, the real potential danger, guys, comes up when you break this rule to buy an even more expensive home. So, guys, the biggest thing to remember is that with rates being low, that you still want to stick to a house that does not go above that 30% of your income ratio. With rates being lower, it does increase your overall buying power, but you run the risk of having a home that is costing you a higher percentage of your overall gross income. With that being said, Joe Dolls, the more income challenged you are, the safer it is to spend less. All right, so moving on to rule number 2, have 30% of your home value saved up in cash. So this rule recommends that before buying a home, have at least 30% of the value of the home saved in cash or low risk assets investment. So again, out of the 30%, 20% would be for a down payment to get the lowest mortgage rate and avoid private mortgage insurance. And then ideally you would have 10% as a healthy cash buffer. Now this buffer can be a combination of different asset classes, but it should be readily accessible. Now the thought process behind this rule, guys, is to make sure you are fairly protected, you're insulated if the housing market were to decline in value. With the 20% down payment, you are much less likely to end up upside down, and you'll be better positioned to ride out any market downturn. By also having an additional 10% in reserves, this can help cover any unforeseen housing emergency or repairs that may arise without having to go into debt. Again, guys, these are rules to protect buyers during this time, as there is a lot of job instability, market instability, and no one knows for sure the direction of the real estate market. Now, if we're honest, Joe Dolls, this 30% recommendation is going to be more realistic in different markets. It just depends on where you are. For example, if you live somewhere where you can purchase a home for $75,000 to $100,000, then having $22,000 to $30,000 in reserves may be more realistic than somewhere where the average home price is $400,000 to $500,000 and what you're looking at $120,000 to $150,000 for a down payment and reserve. Also, homeowners who most suffered during the previous recession had minimal down payments, which increased the temptation to walk away from underwater mortgages. Now, those who did between 2008 and 2012 missed out on one of the largest real estate recoveries. With that being said, Joe Dolls, if you plan on buying within the next 6 months to a year, be sure to keep that 20% down payment in cash. Not a good idea to invest your down payment in stocks and other risky assets if you plan to buy in the near future. All right, guys, so let's go into the final rule. Rule number 3, the price of your home should be no more than 3 times your annual gross income. Now, this rule is just a quick way to screen for homes that are in affordable price range and takes into consideration your down payment. So for example, if you earn $100,000 a year, then you can comfortably afford up to a $300,000 home. Or if you have a top 1% household income of $500,000, you would be able to afford a home up to $1.5 million. Again, guys, with mortgage rates at historic lows, housing affordability has gone up. So you could stretch this rule and extend the home value by up to 5 times your annual household income. However, with a home that is 5 times your salary, it not only means more debt, but it also means higher property taxes and higher maintenance expenses. So let me give you another final example of how this rule would play out in a real world example. Let's say that you or your family makes $75,000 per year. This means that your family's gross monthly income is $6,250 and your mortgage payment should be no more than $1,875. You should also limit your home's purchase price to 3 times, which would be $225,000, and you should have 30%, which is $67,500. Again, guys, these recommendations may be tough for the average family, but running the numbers may still be worthwhile. After all, it's tough to predict what the economy or your job stability may look like in the future. Spending less on a home may not be a bad thing, especially if you or your partner may have already experienced a loss of income. Now, if you're saying to yourself, Joseph, this all sounds great, but I think it's a bit much, there are some things you could do if you plan to violate these 3 rules. So you could consider house hacking for additional income, meaning you could rent out a room or a portion of your house for additional income to help cover your monthly housing expenses. Another option is to start a side hustle, a business to have a legitimate way to deduct a home office expense and other expenses such as internet usage. Other recommendations include putting yourself in a position to get a raise or promotion with a higher salary, and also look into creating new income streams to pay for home ownership expenses. Now, guys, I love real estate and I think that a home is one of the best ways to build your wealth and increase your net worth over time. That being said, there's a lot of debate as to whether the home you live in is an asset or liability. And in my personal opinion, it's both. The key is to make it more of an asset than a liability, and there are a ton of ways to accomplish this goal. So guys, despite all the benefits of investing in real estate, it's best not to overextend your finances. Remember, in addition to a mortgage, you also have to pay for homeowners insurance, property taxes, and maintenance fees. Bottom line, guys, is that although mortgage rates are at historic lows, which has increased the ability of many people to purchase more real estate or even enter the market for the first time, make sure to run the numbers and make sure it's something that you can afford now and also in the future. Expect the best and plan for the worst. If you found value in this video, please make sure to give it a like and share it on all your social media platforms. Don't forget to subscribe and turn on that notification bell as I'm posting valuable new information at least twice a week. Thanks for watching, and until next time.